Hi, I'm Jim Scheinberg, Managing Partner of North Pier Fiduciary Management in Los Angeles, California, a registered investment advisor, and I'm here to give you an economic update as we see it. We're getting some mixed data out of the business-to-business sector that's got North Pier scratching its head a little bit and looking much deeper into the numbers. We've been following the Institute of Supply Management very closely since the bottom of the fiscal crisis and the recovery that's ensued, and found these indicators to be paramount in predicting the stability of the recovery or when it has actually quelled a little bit. Well, the manufacturing data that just came out earlier this week showed a surprising contraction. The May information is showing a number down to 49, whereas we were looking at a reading in April of 50.7. Going beneath the numbers, we're actually seeing that new orders and backlog orders have dropped dramatically in that 1 month period. And in addition to that, inventories are swelling. These are not good factors for an expansion in the manufacturing side. On the services side, however, we're seeing conflicting data. There, it looks like the economy is recovering and continues to move forward. The services indication showed a reading of 53.7, which was actually an improvement from 53.1 in April. On the complete opposite end of the spectrum, there we're seeing new orders expand, we're seeing backlogs of existing orders expand, and we're seeing inventories come down. These are all very supportive to show that potentially that the economic recovery is quite good in the service sector. You can see why we are scratching our head a little bit at North Pier. One reason this may be happening is because we are still seeing the effects of sequestration, the massive budget cuts at the federal government level rolling through the economy and giving pause in the manufacturing side of things. The services side may never roll over or may just simply be lagging the manufacturing side, or it could simply be a flinch in manufacturing. We will have to continue to monitor this data closely to find out whether or not one is more the case than the other. At the end of the day, we do believe that these are micro level analysis points and that our general theme is still intact. Our general theme, again, is supported by the fact that we believe there is a full-blown recovery in domestic real estate that is driving all. The recent Case-Shiller findings show that the 20-city index showed a year-over-year increase of nearly 11% in pricing, and wow, is that strong. That leads into sentiment and confidence at the consumer level, and we're seeing continued strength in those indicators there as well, and no rollover in that data, with the Michigan sentiment data coming in at a strong 84.5, which is a 5-year high. Most encouraging in that index is that the current condition number is almost approaching the full 100 point on that part of the index reading. That means that people are feeling quite comfy with what's going on with their personal economic conditions presently. And we are seeing continued strength in the future expectations as well, but not quite as robust. We contend that it is the recovery in real estate that drives the consumer, and the consumer drives business-to-business activity at the macro level of our theme. But we are prepared to be wrong, which is why we wanted to let you know what we were seeing in the ISM data. Stay tuned. We will provide updates if we see cause for concern in those and other key indicators that we're following. Until then, I'm Jim Scheinberg, Managing Partner of North Pier Fiduciary Management.